Welcome to another video, guys. If you're a subscriber, welcome back and thanks for continuing to watch and support the channel. If you're not and you find the video informative and interesting, please do consider hitting like and subscribe down below at the end of the video. Today we're talking about a question on a lot of people's minds right now, which is when are stocks going to stop falling? What's been happening in the market over the past year or so has the potential to absolutely destroy a lot of people's life savings, their livelihoods, their whole lives really, especially if they're highly levered, if they are heavily invested in options, and there goes the dog. So very rough time in the stock market for all of us. I hope you guys out there are doing okay watching this video, getting through it all right. I know it will end eventually. It's just a matter of when. I know for myself, my total net worth has gone down dramatically over the last year, especially because I do invest in a lot of high growth stocks, which have been the hardest hit. So it's definitely been a painful year for me, but I have not been over leveraged. I have not made too many crazy margin plays or option plays. When I do an option trade, I do so knowing there's a chance it could go to zero, and I only spend the money if I know I'll be perfectly fine if it does go to zero. So I encourage you to take that philosophy as well if you are buying options or selling options, especially short-term options, because it can be a very dangerous game, very high risk, high reward. So I wanted to take a look at a few charts, listen to what a few of the experts are saying, and try to get some idea of where we think the markets may be headed in the next few months. So this is a quick chart of the Nasdaq over the past couple years or so. You can see the big drop towards the left is when the pandemic sort of started, and towards the right is the drop we've had now. So a few things to take away from this. Number one, we've still all done okay, right? If you go back to before the pandemic, the past couple of years, we're still up a pretty decent amount, really. It just feels horrible seeing your account balance go down, seeing your net worth go down. If we had just been steady from pre-pandemic to where we are right now, a lot of us would probably feel completely fine about it. We'd be saying to ourselves, well, it's been a bit of a weak couple of years, but, we've had a global pandemic. We've had some rough supply chain issues. We've had some rough times. We've had a war going on in Ukraine, and we're still up maybe 15% from around 9,000 to 11,500, let's say. So, not that bad really overall if you zoom out, although it has been very painful because we all saw our balances shoot up astronomically. Like, I know for me, I more than doubled. Probably in the last 5 years, I've tripled my portfolio. So when you get, say, minus 50%, minus 40% on something that's already been tripled, it feels extremely painful because those numbers are higher. But zooming out, still doing okay here, although this drop has been very sharp and very painful. Now, if we look at this graph of the Nasdaq, a lot of people are wondering, where is it going to stop? Could be anywhere. Nobody's going to predict it perfectly, but I have seen a lot of technical analysts say that this line here is our solid support. So we highly unlikely will drop below that. That was our previous pre-pandemic high. So if you look, we still have a bit of a ways to go before hitting there, but I would say probably 3/4 to 4/5 of the way there. I don't necessarily think we will drop all the way there for sure. I think we might be getting close to the end here, but you never know for sure. And I think just having that as a baseline of saying to yourself, it's probably not going to go below this level, is nice to have. Now, I know there's some extremely bearish people out there that think it might drop even lower, kind of 9,000, even 8,000 range. I don't think it's going to get that bad. We're seeing valuations drop so far. Multiples are dropping so low that I just don't think it can can drop that low unless we have some extremely poor earnings coming out over the next couple of years, or I find that very unlikely. Let's jump into a few clips of what some of the experts are saying and weigh in on the opinions of the quote-unquote talking heads on CNBC. Okay, here we have former AOL CEO Tim Armstrong. Let's listen into his comments on the current market situation.
Yeah, Becky, first, great to see you. And, I think the Nasdaq 100 is roughly down, 28, 29% this year. And I think if you look at the Snap specific results, I think that's more individually about, Snap and what their guidance was and things. I think if you take a step back, from tech, as an investor, I think one of the things that you have to do is step back in the batter's box at this point, even though it's really hard and there's probably going to be a lot of fog on the economy. When you look at the overall tech results right now, the average after the stock market has had corrections of this size, and I think we're in the top 7 corrections of all time right now, the averages going forward are typically, over the next 3 years, like a 35% return. Over the next 5 years, typically, 80%. So when you look at tech as a macro play, I think the tech stocks are down enough now where you can start getting in the batter's box and looking at different companies very carefully. The balls are slowing down. You can start to see people's results, and people are getting more results focused. So I think even though it's very bad news across the board for tech over the last, 3-6 months, you're probably in a great time to invest.
So I really like what he was saying there about looking at historical pullbacks like this, and what happens over the next 3 to 5 years is on 5 years out, you're usually up about 80%, and he's looking at buying. So I always like to look out 5 years for any company I'm buying, and 80% is obviously an amazing return. So even if we're not at the very bottom, I think we're getting to levels that are pretty cheap and worth looking at adding. I always say, it might not be the very best price I can get, but a good price is still a good price. It seems like Tim agrees with that assessment.
I think there are tech companies that produce a product that's of real value and they sell it at a high margin and they make money. Those are good investments. They were before, they are now. I think where it gets trickier is the tech company where it's like, well, they're not making money. We're not really sure how they'll make money, but it seems so cool. And they got such a high private valuation that we should invest in them anyway. My general rule of thumb is if you don't understand why a company should do well, it's probably not that you're too stupid. It's that, it doesn't make sense.
Just real quick, we got about 25 seconds. Are you closing some of the windows, hunkering down, bringing some wood in for the winter in tech? No?
Yeah, the opposite, right? So I'm an early stage investor. Valuations are down. I'm deploying capital like crazy. To me, this is a really good time to be investing, both because valuations are lower and you have a little more leverage than you had 6 months ago with founders. So yeah, we're investing as much as we possibly can.
Okay, so he's also deploying a lot of capital right now. He feels that valuations have become very cheap and it's a good time to buy. Nice to hear this sentiment from some of the prominent figures going on the news. I know 6 months ago, all I heard was doom and gloom and, bearish people saying things are going to drop, things are out of whack. So as long as you know what the company does, and they have real products and real earnings, I think it's pretty safe to invest in these levels. This one's Larry Haverty. He's been around investing in the markets for a long time. He's seen a lot of different recessions and pullbacks, bear markets. So let's see what he has to say about the current market.
Thing is, there's no such thing as an intellectual bottom. There's only an emotional bottom. Get me out of here. I want to leave Dodge as quickly as possible. So what you have to look at when you're in a period like this is signs of emotional distress, and you have to get that from financial indicators. So a couple weeks ago, there were 1,700 net declines in the New York Stock Exchange. Only once in 40 years has there been a greater number. So we're in the 99th percentile of that. Last week, there was a 12-to-1 day down volume versus up volume. People not only wanted to get out, they wanted to get out quickly. So that would ring the bell that we're very, very close to an intellectual level of the bottom.
Okay, so he's saying there that he thinks we're getting close to at least the levels of emotional capitulation where investors are wanting out that usually signals a market bottom. Let's continue on.
Take this morning, Dick's Sporting Goods. Really, really good retailer. The stock went down 15% on the quote-unquote earnings miss. Well, you can't break your neck falling out of the basement. You look at Dick's, all you know is where it is now. So the company at the bottom of trading today was at 3 times cash flow.
And look at the stock now. It is rebounded just in the last half hour.
33% return. You can't go broke buying companies at 3 times cash flow. There are a number of companies in the retail area trading at 3 to 6 times cash flow. And in the tech area, you have companies like Google and Facebook trading at 10 to 13 times cash flow.
Kind of like that, so you're not going to break your neck falling from the basement. So if we're already in the basement here, there can't be too much more to fall. And he is seeing some attractive valuations. He looks more at the retail space in this video, but I think it's applicable across all of tech as long as you make sure you really understand the company that you're investing in.
The thing that's different now versus 74 is companies can buy their own stock. And these people are very, very sophisticated financially. So you look at Google and you have at 13 times, it's a 7 cash flow cost. Invert 1 over 13.
Right, a 7% cash flow yield.
Yeah. Google's getting 1% sitting with the money in the bank. So you have a 600-point spread. Used to be 500 points was good. For a company like Dick's, the spread's 25, 27 points. So share repurchases are eventually going to moderate things.
Right. Another good point there, actually. If companies start to think that their stock is a really good deal and the best thing they can do for their shareholders is actually buy back stock, how this works is basically you could distribute money to your shareholders in the form of a dividend or just cash. But if I do that, I'm giving you, say, $500. But if I buy $500 of stock back from the market and that stock is really worth $800, in a sense, I'm going to give more value to my shareholders that way, and it will drive the stock further up. So companies do have that option, and as valuations get extremely low, we could see a lot more share buybacks in the future. I know some activist investors have been pushing for that from Tesla and a few other companies, and if the companies are really doing well and the stock isn't responding, then I'm sure that they will be looking at buying back those shares. So bottom line here, are we done dropping? Is the stock collapse over for now? No one can tell you that. No one can be sure about it. If you buy today, will your investment be worth more in 3 weeks to a month, or will it be worth significantly less? No one can tell you that either for sure. But what I can tell you is that if you buy today and you buy a good solid company that has good growth ahead, real products and real earnings, and you hold for the next 5 years, I'm extremely confident that you will do well. So that's kind of the message I wanted to get out today, and just say to everyone out there, I hope you're doing well. I hope you're getting through this tough time, and I think we're nearing the end of it here. So thanks for tuning in. Please consider hitting like and subscribe, and I'll see you next time.